Hello, everyone. Welcome for those who are here and who are not here and will watch it later. I'm Kanchana Ambagahavita from the Central Bank. So I'm just going to move to the PowerPoint presentation and we can start. So today we will be, just before I start the presentation, I can see one person. Let me just see whether I'm heard. Can you hear me? No.
Yes, can hear.
Okay, right. Thanks a lot. So if you, okay, let me see now. I'm not very good with PowerPoint, so please excuse me. So we have two people here, so I'm just going to start. If you have any questions, just feel free to come in and just ask me the question. If not, you can ask at the end. Not a problem. Okay, right. So you can hear, you can see the screen, right?
Yes,
okay.
yes.
Okay, thanks. Okay, so today we're going to talk about payments and settlement systems, the legal aspects. So it's going to be the application of the legal aspects. So I'm going to give you a sort of an outline of what the legal aspects are and how the application is done, because payment systems are fully regulated in Sri Lanka. So whatever I teach here is already based on a law. So therefore, there is both the legal framework and the application, because this is a very practical subject. So addressing it from the application point of view will be most suitable. So I'm Kanchana Ambagahavita from the Payments and Settlements Department of the Central Bank. So just some house rules. I think there's just a few of us here. I'll just basically I like to see who's there, but since there's just a few of us here, let's just carry on and just keep your mics on mute unless you have something to say. And as I said, just feel free to ask any questions or discuss any point. And I think there's a raise your hand button, so you can do that as well. And we'll take a 15-minute break in about 2.5 hours. So around, so it's almost 1:30. So we'll take, let's see how it goes. So in about 2 hours or so, let's see how we're doing, and we'll see if we need a break or not. And yeah, so we'll start from top again after the break. So I always start this session with us with sort of placing some idea of what expenses are. And we have a varied number of expenses in our day-to-day life. So this can be from very small, like buying food, to something bigger, like buying a house, e-commerce payments, stock market payments, financial market payments. So these are all payments. So in that sphere, what we are going to see is what the different ways are for us to pay for these things, and why it is important to have these different mechanisms to pay, and the benefit it's the benefit the economy has and the benefits that the customer has. Yeah. So importance of payments and settlement systems. So every transaction with a monetary value requires the use of a payment system. So if there is a monetary value, that is, if the value is stated by, let's say, rupees or dollars or something like that, then you need to use a payment system to complete the transaction. Of course, if the transaction doesn't have a monetary value, let's say you're doing it as a favor, it is then kindness, then you don't need a payment system because there is no monetary transaction happening. And payments and settlement systems are the systems that facilitate the transfer of these funds within the economy, within actors, across borders, across states, across wallets, across people. So these systems are there to move the funds. The efficiency and the reliability of payment systems is vital to maintain the stability of financial systems. Now, what that means is, if people don't trust payment systems, if payment systems are not efficient, if we try to make a payment and then if the payment doesn't go through, then we lose trust. We don't want to use it again, or we will try it, let's say, one more time, and then we will probably give it up. So it's really important that payment systems have that efficiency and reliability. And when that is so, the stability of the financial system takes place, because payment systems are connected to financial institutions. They are generally connected to money in the bank, money in a financial institution, let's say a finance company, and the whole system, sort of the economy, flows and functions when these systems work properly. If people leave the system, then the fluidity and the efficiency of that system falls, because there aren't enough participants using it. And if people are going through another system, let's say cash, or they give up everything and they go into a barter system, then again that the efficiency of it goes down. So payment systems are quite complex operations. If you're working at a bank and you're in an area that deals with payment systems, you will know some of the complexity of a payment system and the infrastructure. Though the purpose is to really simplify the payment to the customer, and increasingly what you will see through this lecture is how the banks and the central bank and other payment service providers have been continuously trying to simplify payments for the users, and where we sort of cover up most of the complexity. So we have a lot of complexity, but the customer won't have so much complexity. For successful operation of payment systems, it requires sufficient liquidity. So there must be enough money in the system. A set of rules so that all the participants do play the game according to the right set of rules. Otherwise, if people start doing different things, if people are not there, if they don't have sufficient liquidity at the cutoff times, if they don't send their files at the right time, then the system can't operate again. Then trust. People must trust the payment instruments. People must trust the checks or any other payment instrument, the cards, whatever. I will be describing what the payment instruments are. So they must trust it. They must trust that when I use this payment instrument, that the right amount of money will go to the other person at the time that I expect it to go. If that trust is not there, then again that payment instrument will fall into disuse and the payment system will be inefficient. And again, reliability, that safe transfer at the expected time. So some key concepts. So what is a payment? Is anyone here who would like to sort of give an answer for that? Would anyone like to contribute? Okay.
Something due or given as a gift?
As a gift. Do we give a payment as a gift?
No, I mean not a rather something that we. But yes, it's not a payment though. But still, that can also be need to be transferred to another party.
Yes. So a payment is when money, or in this case, let's simplify it and say money, when we transfer it to another person, right? So there will be sometimes a reciprocal transaction. Let's say we buy goods, and then so we give money and then we get goods. So there is a reason why we are paying. There's also a reason. I mean, whatever the reason, it could be a loan, it could be just a gift, as you said. But there is a transaction, a transfer, and a reason that we are passing on the money to someone else. So a payer's transfer of monetary claim on a party acceptable to the payee. So typically what happens is when we make a payment, the payee also must accept it. For instance, if you go to the US and give them rupees, Sri Lankan rupees, the payee is most likely will not accept the payment, the monetary claim, right? But in Sri Lanka, if you give someone rupees, they can't refuse. Like under the law, they can't refuse rupees. But under the law, there are only very specified parties in Sri Lanka who can accept dollars. So it has to be acceptable to the payee. So the way you pay has to be accepted in that jurisdiction in the country, right? Typically, claims take the form of cash or deposit balances. That is balances we have in the bank. Held at financial institutions or at central banks. So where the discussion is, where the transaction is, let's say between banks, institutions that have accounts with the central bank, then obviously their deposit balances are with the central bank. So this is the official definition given by the Bank of International Settlements. So that's common types of payments. We have cash payments, and then we have non-cash payments. We have paper-based payments, which are checks, and then electronic payments. So a lot of our discussion today will be on the electronic payments. I understand that you have already covered checks, so I will be focusing mainly on electronic payments. So electronic payments, we have cards, we have internet-based payments, and then the mobile phone-based payments. So there's e-money, and then there are mobile apps. And now under the mobile apps, we have QR code-based payments in Sri Lanka. I will explain that to you as we go along. So yes, evolution of payment instruments and technology in Sri Lanka. So I'm just going to move into a short video for you to see. If you can't see it, just let me know. Otherwise, we'll just proceed. Let me see. Okay.
During the first phase of civilization, man fulfilled his daily needs by engaging in trade via the barter system, a system that typically treated everyday goods and services as the currency for exchange. He then began to use high-value items such as gems, pearls, and gold as a medium of exchange. However, though negotiable, the barter system did not go on to be used for much longer, as it was deemed impractical and difficult due to its obvious limitations. As a result of the progress of man, sovereign countries and governments were formed, and eventually the prehistoric currency underwent rapid development. The world subsequently moved into paper money and coins for trading purposes. Man got accustomed to using this new and evolving currency system for trading and began to gather wealth for future use. He did so by placing his hard-earned cash in so-called safe keeping spots, but none of these primitive methods proved successful in keeping money away from burglars and natural disasters. As a solution for this issue, it reached a milestone in the area of currency exchange with the introduction of checks. Sri Lanka saw the establishment of Lanka Clear in 2002. Under the guidance of the central bank, the entity essentially automated the otherwise time-consuming check clearing process. The introduction of the automated check clearing process, named Check Imaging and Truncation System, allowed Sri Lanka, second in the world, to introduce such a facility. In an effort to facilitate cash withdrawals 24 hours of the day, banks introduced ATMs. However, in the initial days, the customer had to visit his own bank's ATM for this purpose, as using another bank's ATM was a costly affair. Lanka Clear took the next step forward by introducing Common Electronic Fund Transfer Switch, CEFS, in 2015, which enabled immediate fund transfers among banks. Lanka Clear will be introducing a national card scheme under the brand name Lanka Pay to reduce the prevailing high transaction costs to banks. Its effort is to wholeheartedly support the nation's journey towards development by facilitating secure electronic transactions at affordable costs, eventually creating a pathway towards a cashless society.
So that is the evolution of payment systems in Sri Lanka, a very short video. And what I'm going to do is I'm going to explain to you in detail all these systems. And actually, we have come a little further than what this video is also describing in the last few years. So this video is a few years old now, and in the last few years, we have come further ahead. Payment systems in Sri Lanka have developed further. So the evolution of payments. So as the video described, we have the barter system, and what you really need to remember regarding the barter system is often it is described as a chronological sort of linear evolution from barter to cash to checks to cards, and then now internet. We have mobile phones, we have the QR code, and now we are even moving into Internet of Things, where let's say from a fridge you can pay and directly when you're buying the food. What you need to really understand is that this doesn't necessarily have to be a linear evolution where one cannot go back. So right now we know that apart from the barter system also could exist, but all these other systems are coexisting at the same time. So we have cash, we have checks, cards, internet, mobile payments, IoT, Internet of Things. All these are still there. They're all existing together. And really think, why do we choose different, and we all choose cash at certain times. There are times when we are compelled to use a check. There are times when we have to barter. And so really we need to think, why do we choose between different payment instruments? Is it convenience? Is it legal requirements? Is it trust? Going back to what I first said in the first slide, is it trust? If we don't trust, sometimes we might go just think, okay, I want to pay by card, but I don't feel sure whether my card details will be stolen. I'm just going to pay cash. So there are these elements are always working when we choose different payment methods, and increasingly we will find newer and newer, more advanced ways to pay. And what will really determine the uptake is the trust factor, the availability factor, convenience, and the reliability, that the money, the right amount will go to the payee at the right time. So as long as those elements are in place, then payment instrument will have its acceptability. And if all else fails, we might just decide to go back to the barter system. Like if the value of cash is lost due to, let's say, inflation. If we take the Second World War, Germany had so much inflation, people were using cigarettes as the mode of for transactions. So that is basically going back to barter. So it's very easy to lose this trust and this reliability. So we have to be very careful when we are managing payment systems and instruments and cash and the value of money. We have to be very careful to maintain this very fine balance so that the trust and the reliability and efficiency is all maintained throughout the system. So the payment process, cash. So this is basically, we all know how cash transactions work. Payment doesn't necessarily require a reciprocal movement of goods and services, as I said in the beginning. It could be a gift or a donation. Now, the thing about a cash transaction is there is no third party involved. I have the cash, I give it to the person I want to give it to, and then there's immediate finality of the payment. It's done, it's over. But of course, it does have things like risk of theft if when I'm carrying cash around, damage, germs. So there are these risks as well. So as this very basic diagram shows, when the payer gives cash to the payer, this basically is a cash transaction. This part is optional, depending if it's if someone is buying something, yes, this flow will be there, but then this is the cash transaction. Now, if we go to the non-cash transaction, that is where the complexity starts to come in. There is either paper-based or electronic payments. Right now in the world, those are the two systems, right? So electronic basically is digital payments. And then there is definitely a third party involved because someone is facilitating the payment. It's not cash in your wallet that is being given to the other person. It is something else in lieu of the cash in your wallet. So something that is representing the cash in your wallet. So that's why a third party has to come in and say, okay, this is a trusted facility and I will take over giving the cash on your behalf to the other person, right? So that's where a third party comes in. A bank, a payment service provider, card schemes, e-money service providers, app providers. So there's a whole group of people who become third parties to a payment transaction. And then there's clearing, that is what Lanka Clear does in Sri Lanka. And then there's settlement networks. There are several settlement networks in Sri Lanka. I will describe the main one as we go along. And then you have to, settlement of the payment will be based on the clearing and settlement procedures. So there's procedures. It's not just the instrument. We have the parties, and then there's a set procedure where everyone has to follow the same rules. As I told you before, everyone has to follow the same rules and procedures to make sure that it works, right? And then the payee and the payer usually will interact with only one third party, and that third party doesn't necessarily have to be the same. So I will interact with my bank, and the person who's paying me or the person who I am paying to will interact with their bank, right? But where I am concerned, there is only one third party, which is my bank, and where they are concerned, there is only one third party, which is their bank. They don't need to interact with my bank. But there is a third party. Sometimes there are 4 parties, 5 parties, many parties involved, but the payer and the payee generally won't see that complexity. As I said in the beginning, there's a lot of complexity behind a payment, and the payer and payee most of the time won't see that complexity, or they're not supposed to see it. If they are seeing it, then that system needs to be further improved. And then of course, non-cash payments have better security features. The chances of theft is lower. Things like germs is lower. And in Sri Lanka, we have now mandated SMS notifications and EMV technology for e-payments. So what EMV technology does is it has extra added security, and also so chip and pin basically works for the EMV in the card, right? So that has extra layers of security for the customer, right? Now, if you take, sorry, this image hasn't sort of transferred well, but basically this is a non-cash payment process, right? So you have the payer here and then the payer's bank, right? So now look, this guy is only interacting with this person, but the payer's bank has all these parties to deal with, right? They will do the authorization, and the clearing will happen with the clearing network. In Sri Lanka, it's Lanka Clear. The settlement generally happens if it's a Lanka Clear transaction, then it will happen at the central bank. at the given times through the commercial banks. If it's going through the card systems, then cards have different settlement mechanisms through their settlement banks, which are commercial banks. And then after all that is done, the money will go to the payee's bank, and then the payee will take the money from his bank, right? And then this is just sort of the payee saying, yes, I got the money from you, and the payer saying, yes, I transferred the money to you. So this whole process is where all these rules and procedures, everything comes in really at this point. Are there any questions so far? No? Okay. So in Sri Lanka, the payments are mainly processed through the electronic payment. Non-cash payments are mainly through electronic payment systems that operate under all these rules and regulations. And the rules and regulations are basically there for timely settlement, security, efficiency, and reliability of the system. So this is basically sort of the cornerstone of a successful payment system. So what is a payment system? A payment system is a set of instruments and procedures and rules for fund transfers between and among participants and the entities operating the arrangement. So there are several elements here: payment instruments, procedures, rules for the transfer of funds, and there are several parties and the entity that is operating the arrangement. So there are many parties involved in a payment system, and all this, so if you take the country, it's the collection of all these will become the system, and in the case of a country, it will be called a national payment system. If you have any questions, just feel free to just switch your microphone on and just ask me the question. It's totally fine. And then, so the payment system has a lot of definitions, and this slide basically has all these definitions. So Dr. Anjama, who was a former deputy governor of the central bank, she wrote a book on payments. And so her definition was payment systems include payment instruments, payment infrastructure, that is the clearing and settlement mechanisms, the other ancillary services, that is market players, institutional structures, legal, regulatory framework. So this is where really the complexity comes. And unless you are involved in this area, like we are, most of the time, the payers or the payees will not know how much work goes into getting a payment across in a few seconds. So a national payment system is a term given for all payment systems that are operating in a country. By using central bank issued money, be it cash or cashless, they become a part of the national payment system. So what that means is the central bank issues our currency. We all know that. So everything boils down to that currency that is issued by the central bank. By everyone using that currency, you automatically become a part of that system, and that those transactions are then governed by the rules and laws that govern the central bank issued money, and the way that money is being held by banks, how it can be released. All those become a part of a large payment system in the country. So when discussing payment systems, the focus here will largely be on interbank payment systems, where customers of two different banks want to transfer money using non-cash payment methods. So why do we discuss interbank payment systems here? Is there anyone who will be able to answer why the focus is on interbank payment systems when we are discussing payment systems? It kind of connects back to the diagram I showed in the earlier slide. Will someone be able to tell me? Why not within the bank? No? Any guesses? So the reason that we discuss interbank and not within the bank. So within the bank, if you are aware of how banks maintain their databases, I think most of you might be aware of this already. It is an internal record change, right? So there isn't a big issue when it's a transaction between two customers of the same bank. It's not a big issue. But the issue happens when money has to move from one bank to the other. It's only then the issues of liquidity, the issues of reliability, that is that the money has to actually go, and the time, like does the money actually move at the right time from one bank to the other. All these issues really come up when it's an interbank transfer. If it's a within a bank transfer, it's not an issue at all. And even things like fees and other intermediaries like Lanka Clear. Lanka Clear is there primarily for interbank transactions. It is not there for within the bank transactions. It is there for interbank transactions. And clearing is where banks, I will show this to you as we go along, where banks net their claims, monetary claims at the end of the day. And that's basically what Lanka Clear does. So to see how much each bank has to pay the other bank based on how much their customers have transacted throughout the day. So what is a payment instrument? A payment instrument, now this is very important. When we are talking about payment systems, right? Non-cash payment systems, especially. The payment instrument is very, very important. The payment instrument is the sort of formal definition is the instrument that enables a holder to transfer the funds, right? So what the payment instrument really does I think I explained this in the previous slides as well, is it is a representation that you have money in your account and you're not giving cash, and this instrument is telling the other person, okay, this person has money and I'm going to use this instrument to transfer the money that I have in my account to your account. So a payment instrument is sort of the interface that connects the payee, the person who is getting paid, to the funds of the payer. So instead of giving it by cash, by hand, we are giving it via an instrument. And this might be, the reasons might be we are not physically in a place where we can transfer the money, or we haven't carried the money. We don't need to carry the money. The banks are already holding the money. So I'm just going to give you this, pay you through this instrument so you can access that amount of money that I've told you, and my bank on my behalf will release that money for you, right? That's basically what a payment instrument does. So it's an interface, right, that connects the payee to the funds that I have, and the bank or the third party, my financial company or my e-money service provider, on my instructions, they are releasing the specified amount of money to the person who's saying, I have this monetary claim on this person, right? Those are the instructions that sort of move around. So the non-cash instruments that are available in Sri Lanka are checks, postal instruments. Then there are cards, payment cards, debit cards, credit cards, stored value cards. Then we have mobile-based payment mechanisms. So we have customer account-based mobile payments. So that is the wallets that banks have. And then we have e-money systems, that is Easy Cash and Encash mainly. And then there's internet-based payments. If you, let's say, go on e-channeling, let's say Daras or something, you can pay online. You can pay your phone bills online. So internet-based payments. And now we have Lanka QR-based payments as well. So Sri Lanka is really promoting Lanka QR-based payments these days. We will discuss that later. And now we will, before we start, up to this point, is everyone clear? Can I have a quick understanding of what your backgrounds are? So that since there's few of you here. Since there's, I think about 3 or 4 of you here, just so that I sort of pitch it right, is this, do you understand what's being said? Do you want more detail? Can someone sort of let me know what the situation is? How you because it's the postgraduate course, I want to sort of know that you're getting the right level of knowledge, and the complication of it being online, I can't really gauge. Yeah, can someone volunteer to speak? No? Okay, so I'm just going to move on, thinking that this is okay with you, and I will proceed. So this next section, if for your exam, I think this will be sort of some of the key areas will be handled here. It's rather, as I said, I'm giving a brief outline. I'm not going to the details because this is a highly regulated area. It's not an area with, there are some areas that have very broad regulations, but here there are, because it's a very operationalized area, there's a lot of operational level regulation. So I am not going to go into that level. I'm going to give you a high level overview of what the laws that govern payment systems are, but bear in mind that everything that is taught is governed by some law. It's not practices. It's all based on laws and regulations. So the role of the central bank in payments and settlement systems. So why is the central bank involved in payments and settlement systems? The central bank is actually empowered under the Monetary Law Act. So the Monetary Law Act is the act that establishes the central bank. So we are empowered under this Monetary Law Act and the Payments and Settlement Systems Act to administer, regulate, supervise payment, clearing, and settlement systems, right? And that includes prescribing policies and setting standards for regulating and supervising all payments and settlement systems in the country. So it's a very, very broad ambit of regulation that is there regarding payments and settlement systems in the country. So the central bank operates the RTGS system, that is the real-time gross settlement system of Sri Lanka, and has delegated the power to facilitate payment clearance. So under the Monetary Law Act, we also have the power for to operate clearing systems, and we have delegated that power to Lanka Clear. So Lanka Clear is owned by all the licensed commercial banks and the CBSL, right? So all of us, all the banks and all the commercial banks and the central bank are shareholders. The central bank has the largest shareholding at the moment, and it's sort of a consortium, so that everyone owns the system. So it's basically everyone's responsibility to make sure that it works well. So the Payments and Settlements Department was established in 2002 and sort of executes the functions of payments and settlements on behalf of the central bank. And we also have something called the National Payment Council. So it's the highest decision-making body regarding payments and systems and financial infrastructure in Sri Lanka, and it makes recommendations which the central bank takes into consideration. All the commercial banks and all the other banks as well, and including other payment services providers, are represented in the National Payment Council. And everyone discusses on what the payment system policy of Sri Lanka should be. So the legal framework on a more detailed level from the Payments and Settlement Systems perspective, we have the Monetary Law Act, as I said, makes central bank, the Section 5 of the Monetary Law Act. Central bank is the authority responsible for administration, supervision, regulation of monetary, financial, and payment systems of Sri Lanka. So those three go together: monetary, financial, and payment systems, because it's through the payment systems that the monetary and financial systems are operated, because the fund flows happen through the payment system. So it's very important that all three are in line. And then you have Section 62A, which gives the central bank the power to establish and operate systems of fund transfer, settlement of payment obligations, and issue system rules for participating institutions. Now, this is what I meant by that it's very complex. So for each payment system, you have a set of system rules, which the operators, the members have to follow. So it gets really complex, and these can go down to very, very granular levels, like the time of closure or the time of opening. So it's very, very sort of complex. And then at a large level, at a sort of higher level, at the national payment system level, you have the Payments and Settlement Systems Act, right? So the Payments and Settlement Systems Act is there to regulate, supervise, and monitor payments, clearing, and settlement systems, and also money service providers. It facilitates electronic presentment of checks. And then we have to prepare a national payment system plan. This is where NPC and everyone comes together, right? And it's also a very powerful act where the central bank has the power, if anyone is engaging in or is likely to engage in providing a payment service, that person will fall under the Payments and Settlement Systems Act. Now, whether they are directly regulated is up to the central bank. The central bank will identify groups and specify, but largely everyone has to follow the requirements under the Payments and Settlement Systems Act, right? So even if they're likely to engage, they kind of fall under the Payments and Settlement Systems Act. So as I said, it's a complex legal structure. Under the Payments and Settlement Systems Act, we have the way it's structured is the Payments and Settlement Systems Act has a very broad overview. And under that, we have the power to issue regulations, guidelines, directions, circulars. And it is through those when we identify certain areas that require extra regulation, and then we sort of address those areas. So one of our main regulations is the Payment Cards and Mobile Payment Systems Act regulation of 2013. So please note that it's 2013. So that's like 7 years ago. So Sri Lanka has had the regulatory framework required for mobile payments and apps for a long time, but now we are really picking up. So the legal framework has really been sort of far-reaching and forward-looking, and the Payments and Settlement Systems Act itself is 2005. So from 2005, there's been a lot of space for technological innovation in payments, because this act really allows technological advancements. That's the way this act has been written. And then under that, there are guidelines. Then we have the minimum compliance standards for payment-related mobile applications. This again is very important because it gives the standards for mobile applications. So payment apps have to follow to ensure the right amount of security and the safety of funds is ensured. So since this is a legal aspects course, you don't have to, for sort of examination purposes, you don't have to focus on sort of this area, but the higher area you may want to sort of keep an eye on, right? Then the institutional framework. So the institutional framework, as I explained earlier, it's a complex. When we say payment systems, it includes the laws, the regulations, the systems, the actors, everyone is involved. So the payments institutional framework of Sri Lanka includes the central bank, commercial banks, all the banks, card schemes, mobile network operators, fintechs. They're the latest group, and then there's Lanka Clear, which is the clearing agent. So all of these are included in the payments institutional framework, right? NPC, as I explained to you earlier, it was this is the council that does the highest level decision making. So it's been there from 2006. So in line with the Payments and Settlements Systems Act, there was a modernization program for payments in Sri Lanka, and the NPC was also established. As I explained, it has stakeholders represented in the industry. Sorry, there's a numbering error here. And it's responsible of developing a 5-year roadmap for the development of payment systems in Sri Lanka. So every 5 years, every year it's reevaluated, but the plan is for 5 years. And then there's Lanka Clear. As I said, Lanka Clear is for interbank retail payments, right? So it's for retail payments, and we will discuss what retail payments are in a bit. And Lanka Clear provides clearing facilities, right? So clearing is where, at the end of the day, there will be balances, there will be claims for banks to pay each other because their customers have been moving money around all day. And then Lanka Clear basically sees at different points of the day what is the net liabilities that banks have for each other. And that is sort of a very broadly what the clearing facilities that Lanka Clear provides, right? And it started off as the Sri Lanka Automated Clearing House, and then it was changed to Lanka Clear Private Limited. The SLH, the Automated Clearing House, was actually operated by the central bank, and then it was moved to Lanka Clear, where the entire industry owned it. So, as I said, it was owned by it's owned by all the commercial banks and the central bank. So now we are going to get into each and every settlement system. Are there any questions? No? Okay, very well. I will proceed. So, electronic payments and settlement systems. So, when we take payments and settlement systems, we have large value payment systems and retail value payment systems. And there are reasons why it's separated between the size of the value, right? So retail is smaller values, and obviously large is large. And under retail value payments, there are a number of payment systems. We have the check imaging and truncation system, cards, slips, banking, e-money, and even from SEFs, you will see that there are a number of other payment systems that are connected. And where large value payment systems are concerned, there is one large value payment system in Sri Lanka, and that is the real-time gross settlement system, right? And if you are interested in payments, or you want to know what are the numbers, how much volume and value go through Sri Lanka's interbank payments, you could go to this link which has the payments bulletin. It's a fairly detailed bulletin with all the statistics. So in Sri Lanka, the large value payments are so much more than the retail value payments. As you can see, it's about 90% of total cash-based payments, right? So it's a fairly high number. So when we take large value payment systems, right? Basically, what does the large value payment system do? It stops you from having to carry a very large amount of money around, right? And so large value payment systems, because of the value, it becomes a high priority payment, right? So large value payment systems can handle high values as high priorities, right? And they're really important for the efficient functioning of the economy, because all large payments like trade payments, financial markets, government debt, foreign debt, all those some very large payments go through these systems, right? Now, as I said, Sri Lanka has the RTGS system, and most countries have a single RTGS system. So the countries won't have like multiple real-time gross settlement systems or large value payment systems, simply because you don't get a lot of volumes, right? For a day, if you take the total volumes of a large value payment system and the total volume, so this is a number of transactions of a retail payment system, I mean, the numbers are so much different, right? Like, for instance, like how often would we buy a house and how often would we buy milk? So it is that sort of frequency that we're talking about. But in Sri Lanka, the volume is low, but the value is very, very high, right? So there's a daily average of a total of 373 billion. In the last year's fourth quarter, there was the average daily total transaction was 373 billion, right? So it's a very, very, this is what we mean by large value, right? And in most countries, the large value payment systems are operated by the central bank. And that's because commercial banks have accounts with the central bank. And sometimes the banks might not have sufficient liquidity to process the payment, that monetary claim. And when that happens, the central bank structure is able to help the banks out in sort of short-term liquidity requirements to make sure that the economy continues to function and all the payments are made on time, right? So the stock market, financial markets, OMO, that is sort of open market operations. A lot of these transactions happen through the RTGS of Sri Lanka. So it was established in 2003, so it's a fairly old system now. And so what is meant by real-time gross settlement, right? So in other transactions where Lanka Clear is involved, there isn't gross settlement. It is net settlement. It is the money transfer between banks is not real time. It'll happen at the end of the day or in a clearing cycle. But where gross settlement means each transaction is settled individually. And once it is settled, you can't sort of reverse it. Like sometimes, for instance, if we make a credit card payment and something goes wrong, we can reverse that payment. But RTGS payments, you can't reverse it. Once it's done, it's done. Because there are large value payments that go across, right? And participants who are in the RTGS system, so everyone can't become a direct participant of the RTGS system. You need to be a commercial bank, and you have to have a settlement account at the central bank to become a participant. There are indirect ways of joining RTGS. So some banks have relationships with the member bank, and then their transactions will happen through that member bank. About 90% of the value of transactions all the total value of transactions in Sri Lanka is through the RTGS system. And so that's why, though the volume is low, the percentage of the value is about 90%. So most of our non-cash payments are going through the RTGS system. And the majority of these transactions are interbank call money markets, government securities, open market operations, the rupee leg of foreign exchange market, right? And urgent customer payment. So if as I said, if you want to buy a house, let's say, and someone says, okay, pay it tomorrow, or today, we can make it through, because RTGS real time, we can make it, we can make the payment through the RTGS system, right? And also all the net obligations under the clearing system. So after this, I will explain the retail systems. And the retail systems, as I said, Lanka Clear settles them. They will, clears them. When Lanka Clear clears the settlement, what is giving is the total outstanding, the net obligations between participants. All those net obligations are sent to the RTGS system, and those are also settled using the money that banks have in their central bank accounts, right? And so to be a participant of the RTGS, you need to maintain sufficient liquidity in your accounts. Otherwise, you can't pay on a real-time basis. You need to have enough money in your account. So banks, there are guidelines, there are a lot of procedures and regulations as to how much money they have to maintain. And to mitigate this settlement risk, right? Because there is a settlement risk involved. The central bank provides something called intraday liquidity facility, right? So within the day, the bank has to settle with the central bank and the primary dealers as well, right? So for government securities, they also have accounts with the central bank. So this intraday liquidity facility is free of charge. There is no interest on it. This is just the central bank provides this service to ensure that the system runs smoothly, so that someone who uses RTGS will have their money settled on a gross basis, and they don't have to wait for days for their money to go, right? And it's against the securities, the government securities that banks have in the Lanka Secure system, right? And then by the end of the last year, there were 37 participants in the RTGS system. So the central bank is one. We have the commercial banks and primary dealers. And then there are some special participants who have been allowed, which is the EPF and the Colombo Stock Exchange. So before we move to retail payments, and let's sort of touch on what gross and net settlement is. These are, again, important concepts, and this is where RTGS and the retail payment systems differ. So a gross settlement is where bank, let's say bank A, has to pay bank B 100 million, and bank B has to pay bank A 50 million. So in the gross settlement, this happens on their own. So two separate legs, 100 million goes, 50 million goes. In the net settlement, these two are netted out and only 50 million goes, right? So this is what Lanka Clear does. In the RTGS system, each transaction goes on its own, right? And this happens at a higher frequency than this. This might happen end of the day, maybe in 2 or 3 cycles a day, but this has to happen in a very sort of short period. It has to be settled. So as I just mentioned, all electronic payment systems are settled on a deferred net basis. That is the net, so it's not immediate, it is after some time. So this is between the banks, right? Remember, it's not necessarily between the customers. It is between the banks, except for RTGS. Retail value payments, right? Now, retail value, I put all these pictures here because I wanted to just, in case, I'm sure all of you already know this, but what is a retail payment? A retail payment is generally a smaller value payment, like a lower value. But what is a lower value? And it's subjective. So a lower value can range from buy fruits at a vegetable to jewelry, a car, clothes, even a house can. A payment to a house can be made under the retail value payment systems that we have in Sri Lanka, right? So generally, retail value payments are for payments like lower value payments, for consumer level payments, businesses, public authorities, not large sort of government level payments. And they account for most of the payments in the economy, but the value is less. So a common way of defining retail payments is through the payment mechanisms or the instruments. So card payments, direct interbank transfers, checks, e-money products. So those are all sort of retail level payment system, retail payments. So Sri Lanka has about 6 payment systems that we will discuss, right? And these are the official payment systems that are operated by Lanka Clear and then by the banks, right? So first we have the check imaging and truncation system. Then we have SLIPS, the interbank payment system, common electronic fund transfer system, a switch. So these are our switches, sorry. We have the ATM switch, the card schemes, and internet banking, mobile banking, all those systems. So as you can see, using all these, we can probably buy any of these items, right? That's why I said it's very relative what is a retail payment. And I just have to mention that where the RTGS is concerned, it has no upper limit. So you can pay any amount, and there's also no lower limit. So you can transfer any amount as well. So it's both high value and also time critical. So if there's some really urgent payment, those days, that is about 4 years ago, RTGS is the place to go because you don't have to wait until the end of the day for the transaction to happen. But now, time critical for retail, you have other methods like SEFTs. So now that time critical factor is not so important because you have SEFTs basically, which is real time. So check clearing. Checks are the most widely used payment method after cash. Checks are really popular in Sri Lanka. And check clearing was, as I said earlier, it was done by the central bank and then it was moved to Lanka Clear, right? And so Sri Lanka's checks have the magnetic ink recognition system as well. And SITS, which is the check imaging and truncation system, basically it facilitates checks to be presented electronically. If you recall the Payments and Settlement System Act, one of its main provisions is the electronic presentment of checks, right? So this is where that is connected to. So what if you have, I'm sure all of you have either been directly involved in SITS or you have written a check in the recent past, right? So now the actual check doesn't go to the other bank, right? It's the image that goes. So the bank that you deposit the check in just sends the image to Lanka Clear. And it is through this image that the settlement happens. And then the bank holds on to the check until, unless if there's some sort of legal requirement or something like that, like a court case or something like that. But other than that, it is the image that gets processed. And the SITS, what it did was, this electronic presentment, what it did was, the benefit was that it reduced the check clearing time. So those days, previously, it took sometimes 6 to 7 days for a check to be cleared. And now it's T+1, right? So T+1 is next day. And the entire country is now connected, it's quite an efficient system. And I think this is probably the reason why checks are rather popular in Sri Lanka and remain to be popular. But we see that the usage of checks are going down. Sorry, this is the volume. So both volume and value are going down. And actually in Sri Lanka, interestingly, even though checks, you can write up to about even 100 million or even a bit more than that, checks are used for very small amounts. So it's actually a waste. Sometimes the value of the check the check leaf is higher than the amount that is transferred using the check. So it's interesting that this number is slowly sort of going down, but notice we are talking about rupees billion here, right? And hundreds, thousands of checks, hundred thousands of checks, right? So even though the graph is going down, the axis will show you that it's a very high volume. So still the volume is very high. So then we go into what is systemically important payment systems. Now this is under the Payments and Settlement Systems Act. If an act is, if a payment system is systemically important, right? That means if its failure has the potential to endanger the operation of the whole economy, it becomes systemically important, right? So the system can be affected by it not working. So there are two designated systemically important systems in payment systems in Sri Lanka. One is RTGS. Now, RTGS is because of the value, because of the sheer value that goes through the RTGS system. It's systemically important. If there is any delay in the RTGS system, in the settlement, financial markets could be frozen, foreign payments could be stuck, and then there would be sort of a cascading effect, a cascading negative effect on the economy, where people don't get money on time, transactions are not done, interest is lost, or interest has to be paid. So then that becomes systemically important, right? Then SITs, the checks, it's systemically important. It's systemically important for the opposite reason, because it is high volume. So if SITs doesn't work properly, people are now expecting a check to be cleared within by the next day. So if that doesn't happen, right, then it's a problem. The merchants won't get their money on time, they can't buy their supplies, the supply chains will fall, and so the economy could be adversely affected again if SITs doesn't work. So for those two reasons, they have been designated under the Payments and Settlement Systems Act as a systemically important system. And once they are designated as so, they fall under a new regime of even more complex regulation, and they have to follow very stringent procedures to ensure that they will remain functioning and any sort of faults are minimized. So slips, we're coming to slips. Slips is the Sri Lanka interbank payment system, right? This is one of the oldest systems we have. It was introduced in 1994, right? And as the name says, it is the interbank payment system. So it is the first, right? And what slips allows is automated periodic bulk payments, right? So things like salaries. Now, a company will pay salary every month, and they will send a bulk file with all the employees lists and how much they have to be paid. They will send it to the bank, and then on the day, let's say 26th, they will send the money to the bank, and then the money will get dispersed from one account to many accounts. So that provision is there for in slips. It will go from one account, let's say Bank of Ceylon, it will go to accounts in many other banks. So that is the facility provided by slips. And slips has both credit transfers, that is, you can push the payment, that is from, if for example from BOC, the money will get pushed into accounts of different banks. And also it has the direct debit facility. Now many people don't know the direct debit facility. Direct debit facility is where if the customer gives the instruction to the bank, it is to authorize them to pull the payment. So instead of the employer giving the money and instructing, okay, pay everyone, here's the money, pay everyone, the employer tells BOC, okay, on the 26th day, take money, and this person, the employee will say, look here, I want this payment, and the instruction is generated from the employee to the employer's bank, and then the employer has allowed that employee to, let's say, pull out 10,000 rupees. And so it's a pool payment, right? But that all you have to give a mandate. A simpler example is, let's say, a standing order. It's not not a standing order, but a monthly payment, where, let's say, the electricity board, we have told the electricity board, look, every month you can pull out 2,000 rupees from my account. And then the electricity board on the 25th day will contact my bank and say, hey, this person has given me permission to pull out 2,000, and here is the authorization. And then my bank will release 2,000 rupees, right? So that is the direct debit. It's the other way around. Then with the establishment of Lanka Clear, now this is operated by, SLIPS was operated by the central bank. In 2002, it was moved over to Lanka Clear again. So the bulk payments have to be pre-authorized. And in 2010, SLIPS went online. So until 2010, it was a manual process. And it also became T+0. That means by the end of the day, a SLIPS transaction is processed. Now, the other day we got a call from a member of the general public, and he was asking us what time he will get his salary, because his friend has already gotten his salary. And then, so what we explained was that his friend has most likely has the account in the same bank as the employer does. So it's an internal bank transfer. So it's just between two accounts. So he will get the money faster. Whereas if your account is with another bank, then it's at the end of the day, because it's going through SLIPS. So that is the difference. It's settled on a net basis and multilateral net basis, that is between multiple banks. And the net balances that arise come at the end of the day. Sorry, it's in 2 business cycles now, to the RTGS system. And then using the balances that banks have with the central bank, it gets settled. So the number of cycles increase and change depending on the volume and the frequency that transactions come. So if there's a high volume coming, then the cycles are changed, right? And those are generally done through circulars. And by the end of 2019, there were 45 participants. Now remember, SLIPS and RTGS is different. SLIPS is not a central bank based system. The system is through Lanka Clear. So there isn't that distinction between commercial banks and other banks, because only commercial banks have accounts with the central bank, and then there are primary dealers. But with SLIPS, the specialized banks, finance companies, they all have relationships as well, right? And SLIPS transaction types. So we have the credit transfers, as I mentioned to you, salaries, standing orders, all of those fall under credit transactions. And the same can go the other way as direct debits, like insurance payments. Generally, if there's sort of fixed payments that can be pulled, then you can have the direct debit facility. In Sri Lanka, direct debits aren't so popular. Now, if you take the UK, direct debits are very popular. Most of the people's utility bills, standing payments like insurance, rent, all of those go through direct debits. And actually, not only that, even things like, if you're making a payment to a charity every month, like £10, 10 pounds or something like that, even those, they request direct debit authorizations, because it's very easy for the company because they get the money for sure. Otherwise, the customer will forget to pay. So the real benefit of direct debit is that we're avoiding forgetting to pay. But of course, credit transfers gives the customer more control over their money. Let's say you have a 15-day grace period and you don't have the funds to pay today. But if you have given a direct debit, definitely the money will get pulled out on that day. But if you will get the money in 15 days and you have a 15-day grace period, then you can, in a credit transfer, you can delay it for 15 days and pay. As you can see, the use of slips has been going up, which is, again, the volumes and values are not as high as checks. Let's go back and see. Yeah, it's not as high as checks, but still quite high, right? Because this is again probably like one of the most popular ways of paying, and the high volumes come a lot and the high values come a lot because salaries go through slips. Most companies pay their salaries through slips. We are going into the retail payment infrastructures now. Why don't we take a break and we'll come back at, it's about 2:40 now. Let's come back at 5:23 and continue. We have a bit more. We have the retail payment systems and the fintech innovations. In the next slide, in the next few slides, we have that. I have put in a break at this point. I think a bit later, but let's come back and do it in about 15 minutes, if that's okay, right? So is there any questions before we go into a break? Does anyone have any questions? No? If you'd like, you can type in your questions and I can take a look and answer in the second half. Of course, I do encourage you to engage and ask the questions, but if you like, you can also type in the questions. It's not a problem. So I will see you in 15 minutes. Thank you. Welcome back. I hope you're all still there. So does anyone have any questions before we start the next half? So can I ask you to just send a message or something so that I know you have returned, or if you'd like to just switch on your mic and say something so that I know that you have returned. I can wait a few minutes.
Madam, what is the, yeah, I am Karinda.
Yeah, Karinda.
What is the maximum amount we can transfer via as a slip payment?
What?
What is the maximum amount per transaction?
Sorry, I can't get the maximum amount. I can't hear the payment system.
Yeah, via slips.
Slips, is it?
Yeah.
Slips. If I'm not mistaken, it's 5 million per transaction.
Okay, thanks.
Yeah. So SEF is 5 million as well per transaction. So interbank you can go so real time you can transfer 5 million as well.
Thanks.
Anyone else? Are there any other questions? Any other questions anyone would like to ask? Feel free to type anything in. It's a very sort of broad area, and we're covering a lot. So if you have any clarifications, I'm happy to help you in any area. So that's fine, because this is what we do on a day-to-day basis. I mean, this is basically my job. So I'm happy to clarify anything that you have. Right? Even afterwards, if you have any issues, you can always ask. And I think for the exam, I'll just try to sort of tell you what areas you need to focus on. I try to keep it as, because it's very broad, I try to give some indication as to where you need to focus for the purposes of the exam, so that it's useful, and it's sort of some things that you need to know. Yeah, so I'll start with the presentation again. So welcome back. So we'll go to the e-payment, the retail payments infrastructure. And the reason I stopped here is because all this time what we were talking about were sort of the older systems, right? And in 2011, the payment infrastructure, the types of payment infrastructures really changed with the introduction of the common card and payments switch in Sri Lanka. Now, what I mean by change is that world over, the technological capabilities for payment systems changed. Technologies like digital technology was able to do more complex tasks safely. So safety of public funds is really important for payments. So the change with the advancement of digital technologies, countries were able to do that switch into a more advanced systems that were able to be instant, safe, reliable at the same in a very short time, with sort of relatively not, I wouldn't say not so complex systems, but relatively easier mechanisms. And you will see that there is a marked difference between slips and checks and the next systems that we are talking about now. And what technology allowed was interoperability. That is, all the banks to be linked together, so that that delay in settlement, that delay, that sort of like a fluid experience for the customer, where the customer doesn't have to make special take a special effort to pay just because they are a customer of some specific platform, right? So this is why it's called common, right? Payment systems were made common, so it doesn't matter which bank you are connected, your customer of, which instrument you're using. It didn't matter whether, all that didn't matter, because we have started introducing an interoperable system, so that this differences, which bank, which instrument, where are you, what time of day is it, those things become not so important. It's like anytime you want to pay, anytime you want to get your money, you can just get it, right? So that was sort of the idea. And this is and Sri Lanka has always been really ahead in its payment infrastructure. Even slips, 1994 is very early, and SEFs, slips going, SITs, Sri Lanka, sorry, the check image and truncation system, where you clear a check within a day, within the next day, using electronic image. We introduced it in 2005, and UK actually introduced it last year. So we were the second in the world to introduce it. So we have even the systems that I'm going to describe to you now, these are really advanced, and all the advanced countries, and not even some of the advanced countries, still don't have these systems. So we are really ahead. So it's very important that we have a good understanding of what these systems are and what the capacity of these systems are and the services they provide. So as bankers and as the general public, we really use these capabilities to enrich the economy. So CCAPS is a project that we launched in 2011, right? So it's 9 years, and next year obviously will be 10 years for CCAPS. It was a national platform, right? It was established as a national platform for electronic retail payments. So the focus is retail payments. Gross payments, large value payments remain with the central bank, right? CCAPS has been designated as the national payment switch. So it is a switch because, as I said, it is for interoperability. So it's switching between banks, right? And LCPL, which is Lanka Clear, launched the operations under the brand name of Lanka Pay. Now, if you are not a banker who is in operations, or you might not know what Lanka Pay is, but you will definitely have seen Lanka Pay if you have gone to the ATM. You have seen the Lanka Pay logo. You might have seen Lanka Pay ads. You might have heard it. So there's a lot of publicity for Lanka Pay because it is this platform for a common retail payment system, interoperable payment system for Sri Lanka. Now, CCAPS is being introduced in 5 phases. The common ATM switch was there in 2013. That's why you see the Lanka Pay sticker on all the ATMs, because that system was started in 2013. And then you have CEFs from 2015, and the shared ATM switch from 2015 as well. And the common POS and the national card system. If you recall the video, right? The video said that it will Lanka Pay will be introducing a national card scheme. Now it was already, as I said, this video is a few years old because last year we launched the national card scheme, right? And Sri Lanka has a card scheme called Lanka Pay, and I will talk about it as we go on. And there is a common mobile switch, right? So I will just explain these 5 phases to you and what they do, right? So CEFs. So CEFs is really important. Like, it's something that Sri Lankans have to be very, very proud of, because CEFs has really enabled innovation. It has really taken retail payments to the next level, like for the future. It facilitates very futuristic sort of payments. And when I say futuristic, it means real time, any device, anywhere, anytime. So all that has been enabled through the common electronic fund transfer, because as it says, it's the electronic fund transfer switch. So the actual fund transfers between banks happen through CEFs. So it's a very important switch, right? And this has been the basis for fintech innovations. So in Sri Lanka, it was in 2015, and this is not far off from other countries as well, right? And in England, you have a similar system called faster payments, and likewise in many other countries, you have similar retail value systems, right? So these are not large value systems. It cannot transfer the full high levels of value that RTGS does, but for retail payments up to 5 million, this down to 1 rupee or 50 cents or whatever, you can do transfers using SWIFT, right? So it has been the basis for Lanka online payment platform, right? So Lanka payment, LPOP is enabled payment to government institutions. So the first one that went live was customs. So if someone wants to pay, make a customs payment if they are importing or exporting, now they don't need to go to customs and give those forms and, you know, then go to the bank and fill a form, and, you know, all those things are now out. You just have to go online, and from your bank account you can directly pay. So remember, all these CCAPS all these are directly connected to the bank account, right? It's not, there is no like other place that these funds are there, it's to the bank account. So for the government payments, you can directly pay from your bank account and it goes to the Sri Lanka Customs bank account. So likewise, there are many other entities that have now joined LPOP, and most of them are now starting live operations. It is a complex agreements, sort of reciprocal system that, and they have to do some technological updating and developments to become LPOP compliant, because it is a very safe system. All these systems, remember, the problem with payment systems is they have to be very safe. So the security levels are very high. The systems have to be fairly advanced. You can't have sort of badly done digital systems with bugs and all of that. They have to be really good, because we're talking about customer funds. And as I said before, reliability and trust is the key for successful payment instruments. So if that is not there, if that fails, that it becomes a huge problem, right? So in 2017, LPOP went live, and in 2017, also another important innovation happened using SEFs, which is the introduction of Just Pay, right? Just Pay is also a payment infrastructure. What it allows is, it facilitates very low value payments, right? Very small, any amount can go up to 5 million because it's on SEFs, for mobile apps, right? That's why I said it's futuristic. It is for innovation. So for mobile apps, for mobile payment apps, so if you're going to pay someone, you can use Just Pay, right? And the customer directly pays the merchant from the bank account. So the customer doesn't need a debit card or credit card or anything like that. Directly from the bank account through the mobile app, you can pay using using the Just Pay infrastructure. So the customer doesn't see Just Pay, right? It's an infrastructure, it's behind. But the bank will be using Just Pay. And the real advantage, let me see if I have a slide for Just Pay alone. I don't think so. So I will just explain Just Pay here. In case we come again, we can just get to that as well. So Just Pay, the thing about Just Pay is, the merchant, the way that SEFs and Just Pay differs, and why Just Pay is a separate product, is in SEFs, it's an interbank transfer. I'm sure almost all of us now have done an interbank online transfer now. I mean, SEFs has been around since 2015, so I'm sure every single one of us has done now. But we will get a SMS. Sometimes the SMS won't be immediate, right, from the bank. But in Just Pay, the system is written in a way where the SMS is prioritized. So the merchant gets the SMS immediately. Just the way when we make a card payment, you know, the message comes back to the card through the POS machine saying, okay, this person has funds or this person doesn't have funds. So the same way, Just Pay, the moment the money goes to the merchant's bank account, the merchant gets an immediate SMS. And this SMS is fast, because otherwise, you know, at the payment counter, if the cashier has to wait to know whether the money has gone or not, that completion of the transaction won't happen, and then people won't use Just Pay. So the SMS comes immediately, right? So this is SEFs. So SEFs is interbank transfers, and Just Pay is a product from SEFs that enables payment innovations like mobile apps. So directly paying the merchant or the business person from the customer's account, right? So as I said, it supports any time of the day payments. So it doesn't matter whether it's a weekend, it doesn't matter. It can be initiated through ATMs, mobile phones, the internet, over the counter. This is for the fund transfer, right? So even if you go to the bank, since most of you are from banks, you will know this. If you go to the bank and say, okay, 1 million transfer, they do a SEFs transfer now. They don't do a slips transfer most of the time. And if you want it instantly, if you want the money transferred to the other account at the same time, that is real time, you have to ask for a SEFs. Don't ask for a slips, right? If you are someone who handles operations, please ask the customer, when do you want the money to go? Because sometimes customers think that it's a SEFs transfer has gone, but the bank has selected a slips transfer. And then the customer is wondering why the money hasn't gone to the other party. But what has happened is it's a slips transfer that the bank has selected. So if you are in one of those sort of frontline customer engaging points, or if you are managing such staff, please ask them to ask the customer, when do you want the money to go? Because the cost is the same. The cost of a SEFs transfer and a slips transfer is the same. So therefore, just ask the times, whether it's a SEFs or whether it's a slips, right? And actually, there are some banks who are now promoting SEFs because the transaction just happens immediately and the case is over, right? Now, the interesting thing about SEFs, now, why don't we put SEFs and RTGS together, right? Like they are both, the money goes real time. It's because SEFs doesn't settle, the interbank settlement doesn't happen real time. Now, when we say RTGS is interbank gross settlement, the gross settlement happens between the banks as well, right? So, but in SEFs, the settlement is on a net basis. So banks have to maintain certain liquidity requirements. They have to manage their liquidity with the central bank to service SEFs payment. So when the customer wants money transferred, the bank basically sort of gives a loan to the other bank, a short-term loan, and let's say my bank. So how shall I say? Now, let's say I want to pay someone else money, and I transfer through SEFs. So what happens is the message will go to the other bank saying this person's, there is this amount of money from a SEFs transaction to come to your customer. Let's say the customer is A. So what A's bank will do is A's bank will give the money to A. Now A's bank hasn't still received the money from my bank, right? A's bank will receive the money from my bank in a net settlement cycle, right? There is a assigned settlement cycles, and until that time, is the other customer, the payee, the person who I'm paying, their bank will give, it's sort of like a loan given to my bank from that bank. So that is the arrangement, right? That's why I said there are rules and procedures, and all the banks have to follow them. If they don't follow this, the system falls, right? So that bank temporarily will give the money to the customer and say, here, real time, you have now gotten the money. And my bank will do the same if the customer from that bank sends a SEFs transfer to me, right? My bank will give me the money to settle with that other person's bank later, right? So that is the arrangement. So as I said, there are general, there are always regulations. Everything that I'm teaching you is regulated, right? So in terms of SEFs, sorry, just a minute. Video එකද? එහෙම නේද? I'll just ask the crowd. Do you hear me? Can everyone hear me? Yes, they can hear. Can anyone not hear me? I'll just put a message in case. Did someone call and say that they can't hear? Yes. Okay. Right. Hi. Right. Thanks. I'll just put a message so in case someone can't hear, they can send a message to me. See me a second, parent. I'll just put a message. So far, yes. We'll just. Did someone did? Guy and Fernando can't hear. මොකද එයාට එකනෙට ඇහෙන්නේ. එයාට රෙකෝඩින් එක ගන්න දෙන්නේ. එයාට කතා කරලා එකක් ගන්න. Hi, thanks. I'll just put a message to Gayan so that he knows what's going on. Just give me a sec, everyone. I'll just message Gayan, and he apparently can't hear us, but he can see the recording later, I suppose. Right. Because I obviously have to type to Gayan because he can't hear. Yeah. So we will proceed then. Right. Yeah. SIFs, where were we? So it has its regulations with all the key prudential and obligatory requirements that members have to adhere to, this is very important because as I explained, it has a very unique settlement mechanism. So though we think the money is getting transferred between banks, they're not. There's a delayed, there's a deferred settlement, but to the customer, it looks like it's immediately settled. So because of that, it's very, very important that it's very clearly, the obligations between banks are very, very clearly stated out, and it is regulated. Now, SEFs has 39 members. So 24 commercial banks, specialized banks, and 10 finance companies. It is increasingly popular. It's very popular now. And as you can see, the numbers are going up. Of course, the numbers is still not high as checks or slips, right? But we are seeing an increase now. This is for a system that is using the internet, and for a system that is only about 4 or 5 years old, the popularity is increasing, and we find that with the increase of, especially with COVID and all of that, we've seen the numbers going up continuously. You can download now I have given you end quarter data because it makes sense. You can see on a yearly basis how it's happening, right? But you can download the first quarter data is already available for 2020, so you can download that and see. You will find that with COVID, especially in the second quarter data, you will find this. With COVID, the rate of increase would have gone up further, right? Now, with sorry, I'm showing you the wrong graph. Oh, I don't seem to have. No. I suggest you look at the SEFs graph in the payments bulletin, right? This is CAS. So CAS is the common ATM switch. What is the common ATM switch? Can someone tell me what the common ATM switch is? Because I'm sure everyone has used it now. Would anyone like to tell me what the common ATM switch is? Let me see who's there. Would someone like to tell me what the common ATM switch is?
More than 5,000 interconnected to the system.
Yeah.
And January 2008, it consisted with almost members, including members.
So what exactly? And then so what's the common ATM? If you could switch off your mic, Karinda. Thanks. Karinda, if you could just switch off your mic, just because there's a feedback. Thanks. That is exactly what, and then the thing about, again, the word common, right? So common meaning you don't have to go to your own ATM now. You can go to any ATM, any bank's ATM, and access your bank account and get the money. So that is the meaning of common. So all the systems that are coming under CCAPS has that common interoperable feature, right? The cash use has also gone up a lot. Again, it's operated by Lanka Clear. You have seen this logo outside the bank. It's also it has its own obligatory general directions that have been issued to all the members. And again, the banks have to maintain balances so that, when another bank's customer comes, that like, let's say you go to a bank, another bank, and then they say, hey, you can't take out 10,000, you can only take 5,000. This system won't work. And those sort of caps have been operated by certain banks, and we have told them that they can't do that, right? And slowly banks are now making provisions to make sure that it's a seamless experience. The customer cannot feel that they are taking it from another bank. They should feel as if they are taking it from the same bank. I mean, the interface will look different. The selection buttons and all of them will be different, but overall the experience can't change. If you want 10,000 rupees, it doesn't matter whether you're taking it from your bank or from another bank. It has to be the same. You have to get 10,000 rupees, right? So so banks have to maintain extra funds to facilitate customers of other banks as well. And remember, this is reciprocal, right? So all banks have to maintain for all other banks. So even if your customer is going to another bank, that bank will make the same provision for your customer just the way you provide for their customer. So it's sort of a reciprocal thing, right? So all banks have come together to provide this. So far, by end of 2019, we've had 21 LCB sign CAS and 4 LSBs, and 5 finance companies are also in CAS, right? And also CAS has the CDM and the CRM as well. That is the cash deposit machines and the cash recycling machines. So basically, you can go and put money into another bank, and it will go into, so CDM is cash deposit, right? So it's opposite of the ATM where it's a withdrawal. So you can also go and deposit and send the money to your account, right? And then the banks will settle it later. So shared ATM switch. Now this is also a very interesting thing. So to have ATMs, is anyone here working in the ATM sort of area of a bank? Anyone here who is connected today? Is anyone? No? Nope. Is anyone? No. So in the SAS, what SAS does is, to have an ATM network for a bank, it's very expensive. And so all the large banks, all the banks will have it, and the larger banks will have more. To run that system, it's quite expensive. You have to have good cash management. You have a lot of security requirements, and the systems have to be all connected. It requires a lot of money. So for banks that don't have sort of the skills and the funds to invest in their own ATM switch, right, and card management system, because remember, card management system means you have to be able to manage multiple cards. It's not just your own bank's card, right? And then there's also things like Visa, Master, card schemes also change, right? So they can join what is called the shared ATM switch, right? So then they don't directly come through to the cash system, but there is a separate platform that allows them to share the ATM switch of another bank, right? So the RDB and Sarvodaya there are only two participants at the moment, have joined Lanka Pay SAS, which costs far less to be a part of, and Lanka Clear enables this ATM switch sharing. Now we go into electronic payment instruments, right? Now we've discussed so far the main switches, the main retail switches that we have now. We discussed slips and checks, which were the slightly older, sort of early introduced electronic payment systems. So SWIFT, SITs, they're all sort of technologically advanced. The clearing times. Now, when we say technologically advanced, we are talking about not only safety, reliability, speed, right? So slips is T+0, so same day. And checks is T+1, so tomorrow, right? So that also advances it, right? Now we are moving on to electronic payment instruments. Now, at the beginning, I explained what an instrument is. It is anything that allows us to access the funds, right? On not cash, but it is in lieu of cash. How do we access the funds and transfer it to another person, right? So one of the main instruments, now it's been there in the world for about, 50 years, is payment cards, right? Now we have a regulation for payment cards. It can't be issued by everyone. It can only be issued by institutions licensed by the central bank under the Payment Cards and Mobile Payment Systems Regulation of 2013. Right now, we brought in this regulation in 2013. Until that time, it was a different model for issuing cards, but it was properly regulated in 2013. And there are 5 card schemes operating in Sri Lanka. Now, these are international card schemes. Now, what a card scheme does is it provides the technology, right? Because as I explained before, this is a way to access accounts between banks, right? So if you are making a payment from the POS machine at a shop, right? Now the merchant's bank that has given acquired the merchant and given him the POS machine might be, let's say, HNB, right? But my card might be issued from Sampath. Then the money in my Sampath account should go to the HNB account of the merchant, right? So now this message has to go between some system, right? So this system, these technological systems are provided internationally through 5 card schemes, right? Now, if we go abroad, now why are they called international card schemes? Because wherever we go, we can use them. So if wherever we go, we all know this. If there's a Visa sign, I have a Visa card, I can use it. Now, most of those systems are also interoperable. So it doesn't matter whether, most of the time you will have Visa, Master, all these stickers together because they have interoperable POS machines as well, right? Now, what the card scheme does is it checks whether it sends out a call to the account of the other bank and checks whether the person has money or the credit limit to make the payment, right? And then the message comes back. Now, you might, if you use cards, sometimes if the card is stuck, or the authorization has not come, or they have barred the card, or something has happened, the transaction will fail. That is because the system has now, the network has checked whether there is funds or whether the card is authorized. So it's not only funds, right? If the expiry date is wrong, right? If the card is expired, if there's some security check that it is failing, right? Because these networks have a high security requirement, especially now in Sri Lanka, all cards have to have EMV, right? Which is the chip. So it's not no longer the magnetic strip, this strip, it's not that, it has to have the chip now. So if something fails, the transaction will fail, right? So that is what, so all those messages are sent through these card schemes. Now, but what thing about this is, every time we use Visa, Master, or any of those international card schemes, the message has to go out to Sri Lanka and come back, right? It goes to the international MasterCard or Visa centers. It happens in a few seconds. We don't even notice it, but all those checking happens very fast, but the message goes outside. And every time it goes into the Visa MasterCard systems, we have to pay Visa MasterCard. That means the money goes out of the country, right? It's a foreign exchange payment for us. There's huge amounts of money that Sri Lanka loses just for local payments, right? So these are like what I explained, Sampath and HNB, both local banks, but we are paying foreign exchange to make that card transaction. So to overcome this, we launched the national card scheme via the common POS switch, right? Again, common. Now, POS switch is, so in the POS machine, the switch happens between banks, right? So all the local banks are connected to the common POS switch at Lanka Clear, and then the local rupee transactions are routed through Lanka Clear. So it doesn't have to leave the country. It doesn't go into the Master Visa or any JCB or anyone. They don't go to those systems. It is routed locally, right? So this saves us a lot of money. And to make this card sort of useful for people, because people travel a lot and make international payments, even online, we have joined with JCB. JCB is also an international card scheme. It's a Japanese card scheme. So for the international payments, it's routed via JCB, right? And now banks have started issuing and acquiring the national payment cards, and it is slowly picking up. It also has a very low MDR. It's a 1%. It's mandated to be 1%. So other card schemes were charging about 2.5, and now they have also had to bring down their MDR. So I think you might know what an MDR is, which is merchant discount rate. That is the fees that the merchant pays for the POS machine, for all these facilities to enable them to accept card payments. The merchants have to pay generally about 2 to 3% of each transaction, right? Which can be fairly expensive for merchants, especially if you are working on low margins. So banks are responsible for issuing the cards and also the related compliance. And then issuers and acquirers, issuers of the cards and acquirers, that is the merchant acquirers, they have to adopt EMV standard. And we mandated a liability shift. If a party, now in a card scheme, you have a liability to honor the payment, right? Now, if a party doesn't comply to EMV, which has higher security standards, right? This is safety of funds. The liability shifts to the bank that doesn't follow EMV. So if both parties are EMV compliant, then the usual obligations are there, right? But if something happens to the card transaction and it fails, or some fraud or something happens, if one of the banks are not EMV compliant, then the liability shifts to them. Now that is how we made it how we mandated it, right? And all electronic transactions have to be capable of receiving real-time notifications. That's why we get the SMS. Now it is mandated. Since most of you work at banks, you might already know this, right? You have to get the real-time notification, and people have to register for real-time notifications if they are to use electronic transactions. So far in Sri Lanka, we have 32 issuers of debit cards, and credit cards are issued by 17. We have 10 stored value cards, right? Stored value are cards that already have the value stored, so they don't need that connection. It's locally, that data is locally stored, right? And 11 acquirers, right? So though we have 27 commercial banks, only 11 have the license to be financial acquirers of payment cards, right? To issue those POS machines. Now, this is about JCB. I have already explained this to you. Now, it was launched in June 2019. And we started with a debit card. So until it catches up, it will be a debit card, and then we can see whether it's going to be a credit card, whether there is a demand. But it started off with a debit card, and we are having banks slowly sort of coming into this. But the difficulty of payment instruments is the network effect, right? It makes sense for a lot of people to be in some one network. So, or once people are in a bank, they tend not to change their cards. So once banks sort of move out and decide to adopt this, then it will become more popular, right? Now, NCS, the real aim is to bring a lot of autonomy to the country's payment infrastructure, because things being locally routed really increases our chances to do a lot more with it. And also reduce, as I said, reduce the current outflow of foreign exchange in terms of sales, service fees, because it's a very, very large amount. Mobile phone e-money systems, right? So now the 2013 regulation has payment cards, and the other one is mobile payment systems, right? Now, 2013, the real reason, now this started in 2009, and we changed this regulation again in 2013. And in 2009, which is very, very early, right? That was a time when mobile payment systems were becoming popular in Sri Lanka, like M-Pesa. And it was also introduced in Sri Lanka. So, and Sri Lanka has brought in a very novel model for e-money, this mobile phone-based systems. This regulation has two components. One is customer account-based mobile payment systems. That is basically bank wallets, mobile wallets that banks provide. So it is connected to the customer's bank account. So now I think almost all banks have it, right? Most banks have it. And those who are not are developing those as well. And the other one is what is provided by the telecom operators, right? That is Dialog and Mobitel, and others provide it via them, right? So now the first one, where the mobile app is concerned, I think if you are using it, you know that there are many facilities like fund transfers, bill payments, payment payments that can be done through directly. So you're directly using your bank account, right? Now see, this is 2009, right? 2009, we had already made regulations for things that are happening now, right? So the industry took some time, and the people needed things like smartphones and internet, and all those things have now come together. And fortunately, we have the regulations in place to accommodate this advances in technology, right? So now when people are asking for this, there's no problem because the regulatory environment is already there, right? The regulatory safeguards, what has to be done, all that is already there. How do you get a license? How do you get approval? All that has been sort of meted out from 2009. And the e-money system, so Sri Lanka has the unique system of the custodian arrangement, right? So in the case of M-Pesa, the license was given to the telecom, right? Whereas here, the telecom doesn't get the license. The license comes through the custodian bank. So there is one-to-one guarantee of customer funds. So for every rupee that the bank, the telecom operator has in its e-money wallet, the same amount must be held in a custodian account at their bank. So the license is given for both. Right? So custodian bank holds this money in case something happens to the mobile operator, something happens to the e-money system, customers don't lose their money, right? So safety of public funds is number one when it comes to the legal framework regarding payment systems, right? So every single payment system is regulated to ensure the safety of public funds and then financial system stability, right? So that is why the custodian arrangement has been made, because central bank doesn't directly regulate mobile phones, right? It's regulated by the Telecom Regulatory Commission, right? They are the ones who give them the license. We don't give mobile phone companies licenses. We give banks licenses, right? So that's why banks come in as custodians to ensure that public funds are taken care of, right? So far, 2 telcos have been issued licenses to provide e-money, and they come with a custodian bank, right? And e-money, also the systems have advanced. Like initially, it was very sort of primitive sort of arrangements with very limited payment capabilities, but now there is more interoperability. You can top up online. There are so many sort of, you can pay, you can do in-app payments, you can pay online. There's so many things that can be done using e-money. The capabilities have increased with time. So as you can see, the usage is more, there is utility bills. It's being used for utility bills, money transfers, institutional payments, for internet transactions. So it's kind of like fairly spread out, but it's not very large. That much is there. So because Sri Lanka is highly banked, a lot of people don't use e-money system so much because people already have bank accounts. And now with phones, they can access their bank accounts very easily. It really made sense for countries like African countries that were very large, where they didn't have a lot of banks and it was difficult to get money across. But in Sri Lanka, there are a lot of competing systems, but of course, this has a lot of advantages in terms of small value transactions, and you don't have to even to things like topping up. You know, if you're a daily paid worker, you just have to go to the corner shop and get money onto your e-money system. You don't have to go to a CDM, or you don't have to go to your ATM machine or anything like that. You can just operate with a corner shop that's close by. So I mean, it has its own set of advantages, and it targets the very lower ends of the financial sort of capability hierarchy. So this is about the custodian model, right? So this is what I meant, you know, for every single e-money, the cumulative amount must be held in the custodian account, and this is to protect the customer in case of a bankruptcy or any issue like that, right? So service providers should open and maintain a customer account with a licensed commercial bank in which physical money collected from the customers should be deposited. Basically, one to one, it must be deposited, right? Now, this custodian agreement that we had and the way that it was introduced in Sri Lanka was very unique, right? And we actually was featured in this particular 2015 issue of the Harvard Business Research magazine, where it was seen as a unique unique case where the safety of funds and the product was very well regulated, and it was a unique regulatory model. So because we don't have direct regulation over the telecom, we have used the custodian model to ensure the safety of public funds, right? So now we go to the whole new phase, which is payment innovations, right? So the next level. So now we had slips, we had checks, and then we had the CCAPS, which is the Common Interoperable Switch, which enabled all these innovations and real-time transactions. And now we are going to the future, right? Or today. So what is going to happen in the next future, right? So because payments is really changing. The increase of smartphones, internet penetration, and the fact that, you know, people want everything really fast. You know, they don't want to spend time in queues. They don't want to go to shops and buy. They want to pay really fast, right? And payment is not, they want it to be at least hassle. They want it to be very hassle free. So, and so it keeps changing, and there is a lot of innovation in payments. And yeah, so now we are just going to talk about that. Right. So payment innovations, fintech. Now this is a new concept. How many of you, how many are there now? Let's see. Right, there's quite a few of you. How many of you have heard Gayan? Can you hear me now? Gayan is back. So I hope Gayan can hear us now.
Yes, yes.
Excellent, excellent. So can anyone tell me what fintech is? Have you heard of the term?
Financial transaction integrated with technology.
Financial transaction integrated with technology. Okay, so I will take that and I will keep it with me. Does anyone else want to add to that? Anyone? What is fintech?
It's financial technology.
Financial technology. So what does financial technology mean? If you want to just sort of build on what Gayan said. Does anyone want to build on that? Kavindra, are you answering? We can't hear you. No. Anyone else? There is Isivara. Isivara, do you want to answer? This is there. And we have, because now we are going into a whole new type of discussion. That's why I want it to be a Dayaparan. Do you want to give us some feedback on that? No. Right. Jana Ruani? No. Okay, so we have 3 quiet people. So we will just proceed. So fintech, right? So this is important. This is the thing that is the hype and what's happening and continuing to happen, right? So as Kavindra said, it's financial technology, and as Gayan said, it's financial transactions enabled by technology. So that, I mean, both are what it is, right? So the term started really gaining popularity in around 2012 or so. And financial services, so it's fintech is basically increasing the efficiency of financial services, right? And digital technology has had the ability to change how financial services are given to customers, right? So the advantage, the ease of financial technology is that financial services has been one of the earliest industries to adopt digital technology. As you know, all our banks have systems, right? And these systems, if you're in an older bank, these systems could be now about 30, 40 years old, right? But they're all digitized. So they have digital databases. They're not brand new. They're not coming into the digital stream like recently. They have had these systems there for a long time. And this is the case with banks the world over, right? Banks have been having digitized databases for several decades now. But what happened was that those databases and the systems were mainly used for their internal management purposes. And individual and also large value customers. That's why things like RTGSs are much older than things like SEFTs, which so the real-time gross settlement, which was for large-scale payments, is much older. Things like SLIPs, right, which is for main use for things like salary payments. So for large corporates, right, EPF payments. So those are older systems. Those are not consumer level systems. Those are corporate level systems. So for the big customers, there was online systems, but for the individual customers, we still had to use either cash, or we had to we had to use cash mainly. We had to either get cash from the bank, or go to the ATM and get cash, or we had to use a debit or credit card. So other options that we had were very limited, right? So though the systems were there, the transit systems were very poor. Now, even let's say, though real-time gross settlement was there, so that technology was there, right? The real-time, like on the same day in a very short time to settle, the technology was obviously there, but it was not there for customers. So customers, you remember well, right? If you wanted to transfer money to someone else's bank, it takes about 2 or 3 days, and they'll be like, oh, the money came today. If someone sent a check, they will call in about 3-4 days and say, oh, did the money come? And then you have to go and check your bank, or you have to either call your bank and find out whether the check has been realized, right? Sometimes it's a week. But despite that, we know that the technology for real-time settlement was there, right? It was just inconvenient because there were a lot of volume. If there is in a SLIPS transaction or in an RTGS transaction, there isn't a lot of volume. So you don't have to have a very complex system because the load on the digital system is less, right? Whereas the customer level systems, there's a lot of volume and it's very small value, so you don't earn much as well of that, right? So banks were world over. This is not particular to any country. This is world over. Banks were not so keen on taking care of the individual customer. They have been given the payment card. That was enough. They better be happy with it. And the check. So the check and the payment card. That was the two things that customers were given. But with the mobile phone coming and with the internet coming, that really changed. The dynamics, because suddenly there was a technology where the individual customer could connect to the bank. Now since you all know, now things like SLIPs and all, the banks and the corporates also have a link, right? Now they have a sort of a system level link to sort this backs and SLIPs, and I'm very familiar with the UK system, so I keep switching terms. With the SLIPs system, they have a sort of a one-on-one network connection, but if you take the customer didn't have this sort of link, this real-time technology for a real-time link, right? But with the internet, customers suddenly had a technology, a very low-cost technology that they had access already through their computers or through their phones, that they could link with the bank, right? So now this technology, with no doing of the banks or anyone else, this technology was now available to everyone. And devices, right? Customers had internet connected devices. They had the computers, they had the mobile phones. So this meant now customers already have the infrastructure as well. They have the device, they have the computer or the phone, right? So now that also, with no doing of the banks, customers now have the infrastructure required as well. So it is now a matter of connecting the two. Now, banks were very sort of late in coming, and this is because of that, fintech is called disruptive, right? So this, and that's why it's called fintech, because it's not the banks that initiated. It was third parties that initiated this breaking of the barrier between banks and customers. And that this is why it's called innovative, because it's taking things that are already existing and sort of recombining them in a way that is providing new services for customers, right? So the novelty is that we are using mobile phones and new technologies to address the inefficiencies, the barriers in the traditional methods. And this has led to a lot of new products, internet banking, mobile payments. Those are sort of now almost all products. There's crowdfunding, peer-to-peer lending, right? So you can sometimes even forego the banks. You can just do direct interbank transfers, right? Like things like robo-advisories. There's so many things happening now. So what is the difference between the traditional bank techs and the fintechs, right? Now, banks and payment have been having this technology around for about 150 years, right? They used to use wire transfers. And this infrastructure is what they've been sort of building on throughout the years. And so the first cross-Atlantic cable telegraph, that is from London to New York, that was a stock market transaction, that was done in 1867. So that is how old this infrastructure that we're talking about is, right? And this is very important because those stock markets were dealing London, New York, London, Paris, Shanghai, Hong Kong, London. All those things were required because those were sort of large stock markets of this world, right? And then we find the traditional bank technologies, right, have been about almost 50 years old, right? So, sorry, more than 50 years old. So 1958 was the first credit card, right? So Bank of America. So this is a picture of that. I managed to find this one. And then 1966, MasterCard came up with the credit card, right? And then the first ATM is 1967. So we use ATMs now, but they're pretty old, right? And the data management systems were introduced to UK banks in 1968. And so a lot of these innovations come from US and UK because they were sort of the pioneers in digitizing the banking systems, and most of the global financial markets were in either New York or London, right? So they had a reason to go into digital systems early. But most of these systems, as I said earlier, were for internal management systems, right? And so in 1968 was BACS, which is the SLIPS equivalent of UK. And then the card technology keeps improving. And then you have in 1970, the RTGS system is introduced. And then 1995, the EMV standard is introduced, which is what introduces this security for cards, right? And then 1973 is SWIFT. So SWIFT is international. I think almost all of you, if you're in banks, you will know this already. It's the messaging format. SWIFT provides a standardized messaging format to go between banks, right? So world over, you use SWIFT messages. Most countries use SWIFT. Now, Sri Lanka, RTGS, most of our interbank messaging happens using SWIFT protocols. And then, so all that technology was there in banks. But where was the turning point? As I said, the internet and mobile transactions. So internet was there from the 1990s or so. I mean, this sort of very popular internet, the World Wide Web. And you might recall the dot-com bubble, right? So the pre-dot-com era, which is like the 1990s, you have PayPal, and PayPal was the real success. There were many other companies that tried to solve this issue of consumer payments, right? The issue of inefficient consumer payments, especially for e-commerce transactions. And PayPal was actually the success factor. The only successful company that survived the dot-com bubble, right? Even cryptographic transfers, all those were tested out in the 1990s. But interestingly, it was only PayPal that managed to sort of get all the components of innovation plus the business aspect as well. So it's not just technology. You need to be a good business as well. So they managed to get it right. And then you had 2008. 2008 was what is called the global financial crisis, right? And though we call it the global financial crisis, it really took place in the Western countries, and Asian countries that didn't have a lot of exposure to Western country financial markets weren't so affected. But however, it is the global financial crisis. And what happened with that was a lot of people in those countries lost their jobs. And then suddenly there were a whole heap of bankers who had a lot of experience in banking and who didn't have jobs. And they also had a lot of experience in things like payments as well. So, and at the same time, you had the tech boom. So a lot of people who were very good in digital technology, software engineers, and then people had phones, people had internet. So what happened was these guys got together and they started addressing the problems in payments and other financial services using this technology, and the brains of the industries came together and a lot of innovations came about, right? And they started addressing the low value payments, retail payment segment, which before was not addressed because of the lack of profits, basically, because you can't charge a lot from retail payments. Even if you charge 5%, it's still it's not much. And there was a lot of underserved markets in the by the traditional banks, right? And so this started disrupting the traditional business models of banks. And then from countries like China, you had a big boom with companies like Alibaba and Tencent coming into the game. And then so around this time, you had the iPhone that was introduced, and then there was M-Pesa as well, which was seen as a alternative to banks, and specifically serving the underbanked, right? And then around the same time, you also have blockchain and Bitcoin being introduced. So so many things happened at the same time, and fintech boomed in the world, right? And the idea of accessing funds from the traditional banks, from the bank counter, those ideas began to change. That was not the only way to do things, and there were new solutions to problems. And even like very small customers was seen as a person with the right to have a good financial payment experience. And by 2023, it has been sort of they expect the fintech market, only the fintechs, right? These are not banks, these are fintechs, these are non-banks. The market to hit around $460 billion US, right? So if we take global fintech adoption, we can see it's rather high, right? Especially you will see it high in countries that are less banked, because countries with a lot of banks, we found that either banks have now started reacting to this and providing better services to the customers, or the customers themselves are still not adopting new changes because they are still used to their old ways. Because this keeps going back to what I was talking about, trust and reliability. So when customers are used to some way, they tend to continue that, right? So for instance, if you take Germany is very cash based. Like, Germans love cash. If you take United States, they are really check based. They love checks, right? Like, in Sri Lanka you can't forward a check so much and things like that, but in the US you can. They use it just like cash, right? So so because of that, you find that in the more developed countries, the fintech adoption, right, by the customers is relatively less than in sort of less advanced countries. But of course, if you take the case of Scandinavian countries, Netherlands, Denmark, the adoption is very high because, of course, they are smaller economy. I mean, the smaller number of people, so it's very easy to spread new technologies in those countries. China, which had a issue of underbanked, a lot of people being underbanked. So China really leapfrogged and adopted new technologies, and it's been the same in India as well, because I think the Prime Minister Modi took very very bold steps, and with the demonetization and all of that. They also introduced the sort of custom identification protocols that enabled a lot of fintech. So you will find that a lot of factors drive fintech, and mainly it is there to address underserved markets. So where there are underserved markets, you will see fintech booming a lot, right? Now, fintech has been mainly for payments and banking initially, because payments was a low-hanging fruit, and everyone needs to pay, right? So there's so many payment innovations in the world, right? So you have payment processors, you have cross-border payments, you have money transfer systems. Then you have the e-money providers. Then these are the POS providers. These are all fintechs. These are not banks, right? They're all providing some sort of service to make the payment process more efficient, right? And so what we've also seen is that in sort of 2008, 2009, there was a lot of tension. Banks are like, oh, we are disrupted. All these unregulated people are coming into our markets, and it's a big mess, and they're going to lose all the customers' money. But then with time, I think both have sort of understood that everyone has the customer's best interest, and even central banks are becoming more interested, and they're trying to harness the potential of fintech. Because they've seen the potential for digital financial inclusion to reduce the use of cash and really increase the efficiency of payments and banking services. So that because these are both there to make people more prosperous and have a better life, right? I mean, that is our overall purpose as bankers. So financial technology really sort of allows that, and central banks have been pushing it, and now banks also have come on board, and we are seeing interesting dynamics. Different countries have different dynamics. Some countries, the fintechs have overtaken the banks. Other countries going again, sort of collaborating. Others, the banks themselves have taken on technological adoption. So we find different sort of combinations in different countries. And with where payments are concerned, it is the most disrupted, because there was a lot to do and there was a lot of demand, because as I said, everyone is paying. So so there are a lot of mobile wallets and mobile payment applications, and all these services are relating fintech categories, right? And we see that this money transfer, it keeps increasing, money transfer and payment systems. And then we also have other areas like borrowing and insurance, which are all using digital technologies to sort of have a smoother journey for the customer and for the customer to access these services at a lower price and with much ease. So fintech in Sri Lanka. So fintech has been really driven by central bank took a very sort of a positive approach to getting into fintech together with the banks, and we've been sort of proactively promoting fintech in Sri Lanka. We already, so the plus point for Sri Lanka is we already have the infrastructure in place, right? Even if you take the Payments and Settlement Systems Act, right? It was written in around 2002, 2003. Now, in this time, companies like PayPal were already there. So the people who wrote the act already saw the new technologies that were coming into the world, right? They were seeing, though they were not widely adopted, they could see where the world was going. So the Payments and Settlement Systems Act specifically enables the development of modern technologies. Like it has a specific section for that because it saw the way the world was changing, and it has allowed for a lot of technological innovation. And that's why without any amendments to the Payments and Settlement Systems Act, we have been able to bring in all these innovations into the country because they were already forward thinking at that point. The infrastructure, now what I explained before, the switches, now CEFS has been, that's why I was raving about it before, it has been sort of the cornerstone infrastructure for fintech's innovations in Sri Lanka. So with CEFS, as I told you before, we have Just Pay and LPOP. So those have made it easier for customers to pay and really brought down the cost and access the bank account directly, so you don't have to carry money around, right? So remember what as bankers we all know this, when money is at the bank, customers will earn some interest, even though interest rates are relatively low now, as opposed to carrying money in hand, right? There's no return in carrying money in hand. Therefore, all these have allowed customers fintech innovations so that customers have sort of a better experience. And then also based on the Just Pay infrastructure, we introduced Lanka QR code, which I will sort of describe later in a bit. Lanka QR code will be expected to really change the way consumers pay in the future. And there are sort of numerous initiatives that we've been having, and I will explain this to you. So internet-based payments have been increasing, and we are seeing it with the COVID time also, it increased further. And there are so many banks, almost all the banks have online banking, and many banks have their wallets and apps now. So the thing about any new technology, all of that, is that we have to ensure that the relevant legal framework is there to protect the customers, right? So we introduced the minimum compliance standard for payments related mobile applications, right? So any payment app has to follow this minimum compliance standard. So it includes sort of fraud detection, security, authorization, how third parties use these apps. So everything is there so that the customers' funds are safe, right? Funds and data both are safe, right? And banks have to get this certification from us. And it's a tedious process. It's not easy. If you have guys who are involved in this, you'll know it's not easy to meet these standards. So all these are Just Pay enabled apps, and there's sort of more coming in. So what happens is when you are Just Pay enabled, as I mentioned earlier, you get the SMS immediately, and that is what facilitates it as a payment app, as opposed to just a fund transfer app. because otherwise we can just, we can go to the merchant and say, hey, can I get your bank account number? I can transfer you the funds. I mean, it's the same thing at the end of the day. But instead of getting the bank account number, we can either pay through our mobile number, or with the Lanka QR code, we can just transfer the money without having to ask the bank account number of the merchant, right? So because if you go to ask bank account numbers, it becomes quite a tedious task, and you can't, that takes too long for a point of sales transaction, right? There's something called the pen that has been introduced by Lanka Clear, which means that now customers, this is getting sort of picked up at the moment, which is the customers don't need to get the bank account to transfer money. They can use the mobile phone as the unique element for fund transfer. This system is fairly popular in Scandinavian countries, and if you've been to Scandinavian countries like Denmark, Sweden, you will see that in shops the merchants have their phone numbers outside, and customers just transfer money to the phone number. That's how they pay. So the recent fintech initiatives, Lanka QR code. So this is very important. So we introduced the Lanka QR code in 2018. This is a common standard, right? It's a common QR code standard which enables interoperable QR code payments. So between banks, just like in the POS machines. So you can use the HNB card to pay a merchant who has the bank account in Sampat Bank. You can use your NTB mobile payment app to pay a merchant who has DFCC account, right? Using the DFCC issued QR code, which is Lanka QR compliant, right? So now all the banks are supposed to come in a few weeks or so. All banks should be on board. Right, so we issued a circular in 2018, and we did some changes, and again we changed it a bit in 19 based on the needs of the market. Now, the salient features of Lanka QR is that it's a real-time bank-to-bank payment, right? So you pay the merchant directly from your bank, and the money goes directly to the merchant's bank account, right? It's interoperable, right, with all the Lanka QR compliant banks. So as I just explained, the sort of DFCC and NTB can be BOC, whichever, any Lanka QR compliant bank. And then the main aim of QR code of the Lanka QR is to increase financial inclusion, especially digital financial inclusion, and creating a less cash society. So that, because cash is still highly used in Sri Lanka. I mean, it's though we've been talking about electronic payments, cash, the use of cash is so much higher, right? And it's so to do this, to increase financial inclusion and encourage people to come on board and use their bank accounts, put their money in banks, and enjoy more financial services. The merchant discount rate of Lanka QR is really low. It's mandated at 1%, but for 2020 it's 0.5%, right? And the merchant, now this is where it also really is important. Now, in a card transaction, the merchant needs the POS machine. Now, POS machines can be quite expensive. They can be about 50 to 75,000 sometimes. No, actually, most of the time it's quite expensive. But here the merchant doesn't need such a device, right? The merchant just needs a Lanka QR sticker, like the one that you can see in the picture. And so that is given free of charge from the bank. And the customer needs a smartphone to scan the mobile payment, the QR code with their bank app. But from the customer side, it is a very low technology requirement, and the merchant just needs like a normal phone to get the SMS alert, right? Just to see whether the money came in. So it's also EMV compliant, right? So it's internationally, so even if someone is using Visa, MasterCard based apps, they can also use this card, right? And it uses just pay infrastructure, so the payment is real time and you get the SMS as well, right? So this basically a QR code is sort of a card, right? It's an interface that connects, it's a payment instrument that connects the customer's bank account and the merchant. Basically, you are instructing the bank, pay this merchant this amount. Here is the merchant's details, and you get the details from the QR code. Now that's how you get it's a push transaction. The customer pushes the transaction to the merchant, whereas in a card transaction, the merchant will put our card into their machine, and the machine will read our details and say, okay, this is the account we are going to pull. We are going to take this amount of money from this account, and we actually sign an authorization saying, yes, give this much. That's why we signed the paper saying, just take this amount of money from my account. And so Lanka QR code basically gets rid of the added device, which is both the card and the POS machine, and you just have to use the phone that you have. Sorry. So we've started a huge awareness campaign to you might have already seen this one, it's all over, and so we started it with Matale because we are aiming at financial inclusion, and we started in Matale on the 12th of September, so very recently, it was so people in Matale were sort of very excited, the government agent and all of them were very excited because they need alternative ways to get people on board into new technologies. And here we see the governor making a payment. This is the governor of the central bank making a donation to the temple, because anyone with a QR code can receive a payment. And here is the governor making a payment to a vegetable vendor. So very soon all the banks, all the QR merchant acquirers will have this. The merchants with QR code with QR codes will have this on their shops. You know, just like the Master Visa stickers, this sticker will be going on in the shops. As you can see, this you have to just scan the code. So the next sort of those were the products that we have now. Next few slides, I'm going to talk about the even further, the future, and how we are advancing fintech in Sri Lanka, and how all the fintech providers and banks are getting the opportunity to provide more advanced services to customers and have more sort of secure systems within themselves as well. So we introduced the FinTech Regulatory Sandbox, right? And what a regulatory sandbox does is it creates a safe space for fintechs, it could be banks, it could be anyone, to try out new systems and sort of new products to see if they are feasible, whether they work, right? Because most of the time these are sort of smaller products. They will have a larger impact once the product goes live. Anyone can access it, right? So they need to be safe, right? And we need to provide the right regulatory framework to support it. What the FinTech Regulatory Sandbox it does is we will assess whether something is really innovative and whether there's a use case, whether it's good for Sri Lanka, and then we will temporarily, in a sort of a very sort of a controlled environment, we will relax the regulations if they find some regulation is stopping them from providing a good service to the customer and protecting funds and making the whole financial service more efficient. If some regulation is stopping them from doing that, we will then assess this and just temporarily relax this to see whether their statement is correct. And if that is the case, then we see, okay, how can we change this regulation to safeguard the funds, ensure stability, and still allow these new innovations to give the customer and the banking and financial industry a better service. So there is a big process. If you want to, you can go to the central bank website, and there is all the applications regarding the fintech regulatory sandbox. But we don't relax acts of parliament. So it's things like circulars, regulations, or subsidiary regulation that gets relaxed to see if this can work. And if they do, then we see whether it's whether we should go ahead. So it has been in operation from February 2020. Blockchain technology. So blockchain technology is a new, sort of not so new now, but it's all central banks are considering the use of blockchain technology. I have a video here. I don't know whether it'll work. Let's see. I'll give this a shot and see whether it works.
Hi, I'm Brad Callen, and in this video, I'm going to show you how anyone can quickly and easily create doodle videos.
Blockchains are incredibly popular nowadays. What is a blockchain? How do they work? What problems do they solve? And how can they be used? Like the name indicates, a blockchain is a chain of blocks that contains information. This technique was originally described in 1991 by a group of researchers and was originally intended to timestamp digital documents so that it's not possible to backdate them or to tamper with them, almost like a notary. However, it went by mostly unused until it was adapted by Satoshi Nakamoto in 2009 to create the digital cryptocurrency Bitcoin. Now, a blockchain is a distributed ledger that is completely open to anyone. They have an interesting property. Once some data has been recorded inside a blockchain, it becomes very difficult to change it. So how does that work? Well, let's take a closer look at a block. Each block contains some data, the hash of the block, and the hash of the previous block. The data that is stored inside a block depends on the type of blockchain. The Bitcoin blockchain, for example, stores the details about a transaction in here, such as the sender, receiver, and the amount of coins. A block also has a hash. You can compare a hash to a fingerprint. It identifies a block and all of its contents, and it's always unique, just as a fingerprint. Once a block is created, its hash is being calculated. Changing something inside the block will cause the hash to change. So in other words, hashes are very useful when you want to detect changes to blocks. If the fingerprint of a block changes, it no longer is the same block. The third element inside each block is the hash of the previous block. And this effectively creates a chain of blocks, and it's this technique that makes a blockchain so secure. Let's take an example. Here we have a chain of 3 blocks. As you can see, each block has a hash and the hash of the previous block. So block number 3 points to block number 2, and number 2 points to number 1. Now the first block is a bit special. It cannot point to previous blocks because, well, it's the first one. We call this block the genesis block. Now let's say that you tamper with the second block. This causes the hash of the block to change as well. In turn, that will make block 3 and all following blocks invalid because they no longer store a valid hash of the previous block. So changing a single block will make all following blocks invalid. But using hashes is not enough to prevent tampering. Computers these days are very fast and can calculate hundreds of thousands of hashes per second. You could effectively tamper with a block and recalculate all the hashes of other blocks to make your blockchain valid again. So to mitigate this, blockchains have something that is called proof of work. It's a mechanism mechanism that slows down the creation of new blocks. In Bitcoin's case, it takes about 10 minutes to calculate the required proof of work and add a new block to the chain. This mechanism makes it very hard to tamper with the blocks, because if you tamper with one block, you'll need to recalculate the proof of work for all the following blocks. So the security of a blockchain comes from its creative use of hashing and the proof of work mechanism. But there's one more way that blockchains secure themselves, and that is by being distributed. Instead of using a central entity to manage the chain, blockchains use a peer-to-peer network, and everyone is allowed to join. When someone joins this network, he gets a full copy of the blockchain. The node can use this to verify that everything is still in order. Now, let's see what happens when someone creates a new block. The block is sent to everyone on the network. Each node then verifies the block to make sure that it hasn't been tampered with. And if everything checks out, each node adds this block to their own blockchain. All the nodes in this network create consensus. They agree about what blocks are valid and which aren't. Blocks that are tampered with will be rejected by other nodes in the network. So to successfully tamper with a blockchain, you'll need to tamper with all the blocks on the chain, redo the proof of work for each block, and take control of more than 50% of the peer-to-peer network. Only then will your tampered block become accepted by everyone else. So this is almost impossible to do. Blockchains are also constantly evolving. One of the most recent developments is the creation of smart contracts. These contracts are simple programs that are stored on the blockchain and can be used to automatically exchange coins based on certain conditions. More on smart contracts in a later video. The creation of blockchain technology piqued a lot of people's interest. Soon others realized that this technology could be used for other things, like storing medical records, creating a digital notary, or even collecting taxes. So now you know what a blockchain is, how it works on a basic level.
So, right here. So that was sort of a very, not a, I wouldn't say high level. Also, it's got sufficient detail. The importance of blockchain, as the video described, is that it has a sort of a proofing mechanism that prevents tampering of data. So that's very important for financial transactions. And that's why a lot of central banks are looking at it, and so is the Central Bank of Sri Lanka. So what we did was we called for companies to come and develop a POC, that is a proof of concept. So if you are not familiar with the proof of concept, is where it's very popularly used in IT, where you build something small like a prototype to see if the concept of blockchain technology, that is distributed ledger, whether it works, right? So where here in Sri Lanka, we selected Know Your Customer, sharing Know Your Customers, because as you can see, as the video showed, it's a consensus-based system where everyone gets a copy of the blockchain. So it has to be something that makes sense for sharing, right? Then it makes the application make sense. You can use blockchain in many instances, but it should be something where there are multiple parties involved and where multiple parties can share the data. Then it makes more sense to use blockchain. And we are really testing this out to see whether Sri Lanka's financial industry can adopt blockchain-based technologies. It will be in the infrastructure, so customers again won't see, right? A lot of the things that we do, it's back end, right? Like what the central bank does is infrastructure. I mean, even the regulatory framework and everything is infrastructure providing. Like customers don't know what we do, but it makes sure that things flow smoothly, and it is the same for banks and financial services, where back-end services, as long as they function well, there's no problem. If it breaks down, only everyone will start complaining. So so we are really testing this out. So you need to keep your eyes out for this one, and just keep this in your mind. This is fairly important because right now we selected 3 companies and we publicized this, and there were a lot of applications. This is actually, we invited companies to come and develop this for free, right? You can read this. This is the call for applications, and a lot of companies from all over the world applied to develop this for free, and we selected 3 companies, and they are doing in the development process now. And it was a very sort of competitive thing because blockchain is important, and there is going to be a lot of demand. Right now, because banks already have their alternate systems, to switch to blockchain it'll take some time. So it will be sort of a phased approach, but this is something that companies are really considering. So keep your eyes out for this one, and get the logic of security, right? So even if you don't use blockchain, the security in that ensures that the tampering is not there. That's very important. So going ahead, that's why the video is saying to talk about smart contracts, for international trade, all these things that they are using it so that you don't need someone else to authenticate the accuracy of a document or the accuracy of a transaction, because the blockchain itself can do that, right? So I mean, this, if it's done properly, things like transaction banking will have a big effect, because the correspondent banking model might not be required, because you wouldn't need a corresponding bank, because you can directly have peer-to-peer cross-border transactions. You don't need anyone to guarantee the authenticity of documents or the transaction. So that is another sort of future project that's going on. The next one is the development of an open banking framework. Now, this is another area that banks are heading towards globally, right? Which is, what is open banking? Open means not like physically open, but technologically open. Now, digital technologies allow interconnectivity between a lot of systems, right? So because banks are having digital systems with a lot of data, and already the banks are finding it difficult to provide all the types of services that data can provide to customers. There are options of third parties coming and giving services. And one way that they can do it is by giving open interfaces, application interfaces, so that third parties can have some sort of limited access or access to data that the customer has given consent to, and then provide some service to the customer. And already open banking frameworks have been developed in the European Union, in Australia. A lot of countries are studying this, and we are also studying this to develop an open banking framework, because with fintechs coming in, instead of banks individually connecting with fintechs, the development of a framework will ensure that the data that is shared, the way that the data is shared, is secure, and then the customers are protected. Right now, we run on sort of higher level framework, sort of what the Banking Act will provide, or the Payments and Settlements Systems Act provide, but not specific regulation for this fintech and bank connection, right? But what an open banking framework will do is develop that framework that will enable innovation, but at the same time ensure that any customer, any innovation is governed by a strong legal framework to protect the customer data and the customers' funds as well. So that will sort of bring an overarching. So you don't have to have specific, like we have, let's say, the minimum compliance guideline, and then we could have some other. Then we have the cards and mobile applications regulations. Without having multiple guidelines, we can have one framework that will enable innovation while protecting the customer as well, right? Yeah, virtual currencies. Now, this is another important thing that we need to, how are we on time? Okay, we have a bit more time. Virtual currencies is things like Bitcoins. Now, virtual currencies are generally unregulated. The digital money, they're all sort of, most of them, so virtual currencies became popular with Bitcoin. And Bitcoin uses blockchain technology. That's really why Bitcoin became so popular, because it was very safe, because it used blockchain technology. And that was where the world learned about blockchain technology as well. And now the world is applying the technology to other financial services because they realized it was a very good technology. But the thing is with virtual currencies is they are privately issued money. So there is no central bank guarantee. So in most countries, they now operate as like assets, like stock market, like corporate bonds or something like that, where you trade, you make money, you sell. It's more in that sense, and not many people use it as currencies. And also because there were all these issues in the world of where do we put our money to get a good return. There weren't a lot of places. So Bitcoin, the value of cryptocurrencies, virtual currencies, went up a lot. So a lot of people use it as an investment rather than as a currency, because it's more useful to keep it and trade it rather than spend it. And we, like most central banks, we issued a warning about virtual currencies. This was back in 2018, because virtual currencies kind of follow the format of the Bitcoin, which makes it anonymous. It's encrypted, the data is encrypted, so we don't know who is using it for what. There is a lot of risk involved, especially in terms of money laundering and fraud. And also there is the fact that it doesn't have an underlying asset. Now, if you take central bank money, it has an underlying asset. If you take a stock, if you take a company stock, it has an underlying asset, which is the company's assets, right? But virtual currencies don't have an underlying asset, so which makes it very vulnerable for fluctuation. Basically, it doesn't have a value of its own. It is whatever the market has sort of artificially given it. So therefore, there is a lot of risk involved. And there is no regulatory framework because it is a peer-to-peer network. So because of that, we've issued a warning. Right now, there is no regulation. We are studying this further to see how we should regulate it. But we have not authorized any virtual currencies or initial coin offerings in Sri Lanka. They can do it on their own risk if they want, but central bank or no other banks need to take any responsibility because it will be a private transaction, and we have already made the public aware of the risks involved in virtual currency usage. Some other things that are coming up is the central bank and the transport ministry, Lanka Clear, we are all looking at a national transit card. Because we don't have one, right now it's looking like it's going to be a stored value card because of internet connectivity, because when you get on a bus, you might not have the internet connectivity. So it's a local, it's locally stored. The value is locally stored so that you don't need an internet connection to make the transaction. So yeah, this is the process. So we've been 2020 was now we've finished all the payment instruments and systems and innovations. And the banks and finance companies, institutions, central bank, we've put in a lot of money and time to really develop Sri Lanka's payment infrastructure and the legal framework. And it's quite advanced, actually. It's quite ahead of many countries, even some advanced countries. So, but the uptake is slow in Sri Lanka. People are, as I said, people are still using cash. So we are going all out and promoting digital transactions. 2020 was designated the year of digital transactions. And it was interesting because COVID came and a lot of people started using digital transactions. And we are going through a phased approach of um, uh, awareness. And we started this campaign called Cash Vade to show people the downsides of using cash and the conveniences that they get out of using digital transactions. And now we have moved full on into the Lanka QR promotion. So I don't know whether you have seen these in your banks. We circulated this as the first phase of the 2020 promotions, which is to educate all bank staff on the digital payment systems that were available, and so that they can teach their customers. During COVID, there was a lot of, as I said, banks and central banks, we were very busy, as you know, during COVID times. And these were some of the measures that were taken to sort of step up and help customers have access to money. And even though that they were under curfew. And yeah, so I think we've come to the end. And if you need any sort of statistical information, you can go to the payments bulletin. I highly recommend it. Just to get an idea of where payments is in Sri Lanka. It's a very detailed report with lots of nice charts and everything. I always find it very interesting to read. Yeah, that's about it. And before we just close up for the exam, if I will focus on, I try not to complicate questions because what I want is for people to have an understanding rather than trying to sort of catch them off guard. So I will stick to what is in the presentation and what I've taught. And so it will most likely be a mix of the legal aspects. There were some specific slides on that. And then some of the sort of newer payment systems and the sort of the more innovative payment systems that the systems itself that are currently being promoted in Sri Lanka. So that will sort of be the focal points, because those are the more important things you need to know at this point. And where legal framework is concerned, that's sort of the broader overview, because you need to know where to go to find laws rather than what exactly is the law. As a lawyer, that is what my advice mainly is. Right, any questions? How do I get to points? Or there we are. Any questions? Are there any questions? I've come to the end. Does anyone have any questions? Nope. Right, then we will close. And if you need any clarifications, you can, at the end of the presentation, I think is already shared with you. If you need any clarifications, you can just put my name and send. It's the general department email that I put at the end, but you can put my name and just send the email across, and I'm happy to answer any question. You can also, if you like, just call the Payments and Settlements department and I'll be there, so you can just ask me. yeah, or ask IBSL if there's anything that you need. Other than that, I hope this was useful, and yeah, all the best for your for the rest of the course. Thank you.